Hey, Jeff Carlisi here from 38 Special, and we're rocking it up right here with Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have back with us once again in the new year Brad Williams. He's president of Brad Williams Financial Services. Brad, welcome back to Traders Nation. How are you today?
I'm doing great, Kurt. Good to be here.
Yeah, always a pleasure for sure, Brad. Hey, listen, so U.S. consumer debt, Brad, hits an all-time high once again. Credit debt, very bad. Notably, from October's $25 billion non-revolving credit. Okay, so it's non-revolving. It's not credit card stuff. Looking at student loans and auto loans. What's going on there?
Well, with the interest rates being so low, a lot of cars were being sold under low debt, and I think as people started right now starting to see debt, the interest rates rise, they're grabbing them. And I think last fall, as they saw the rates rise, they were grabbing the best deals they could. So that's one of the reasons. Student loan, people are, after the last recession, people, trying to improve their skills. So we've seen that go up. Now, the problem we have with that is that debt bubble, that student loan debt bubble.
Sure.
Because student loans are not often, or I should say often, when you go and you get a degree in Middle Eastern basket weaving and you got 50,000 student loans, it usually doesn't translate to a good job.
Yeah, so you think folks are starting to figure that out, that basket weaving is probably okay in the classroom and easy to get through, but not okay out in the real world in the market, right?
Not if you want a job, a real job. So
right. So even if basket weaving, so let's say they're going back. So let's say you get a bachelor's in basket weaving, they're saying, hey, maybe that didn't work out too good. Let me go back for my master's in something that's tangible. So maybe is it where we're seeing some of that student loan come in, where it's not only just a bachelor's, but they're going even to a higher portion of education, right?
Yeah, and I think sometimes some folks stay in college to delay their entry into the real world.
Yeah.
I've actually had some clients who had issues with kids for that very reason. They kept getting a degree because they really didn't want to have to get to work.
Right.
But oftentimes it's for good reasons. It's just people need to do a cost-benefit analysis of why they're getting a student loan.
Right.
And we've got, the government and the colleges kind of shellacking the American public. One raises their tuition, the next raises the debt limit, and it's like a vicious cycle.
Yeah, I have to agree with that. So let's move on to the autos then. So certainly interest rates are starting to rise. Folks are wanting to pick up a new car. Folks are kind of feeling good. The economy's humming along pretty well, better than they've seen in recent years. They're feeling a little bit more optimistic, would you say? So why not make that purchase before those interest rates move on them? But I guess the other big question is that should they make that purchase? Because getting into debt is a big decision, especially on a car. And Brad, I don't want to keep adding to this question, but Brad, cars nowadays, man, I don't know about you. I went out and looked at cars. It's like $68,000, $70,000 for a car. I'm thinking, I paid that much for my first house. I can't bring myself to buying that for the car, right?
Yeah, I agree. And we just bought a car last weekend. We had a car totaled and had to go get another one.
Sure.
And, I did my shopping, bought a previously owned one, and I never buy new unless there's some extravagant reason for doing it with a deal. But you just shop and get the best deal. But you're right. They are. When you look at like I drove an Expedition before it got totaled, and a brand new Expedition, you pay $50,000-$60,000 for that.
That's a lot of money.
And that's just that is a lot of money, and is it really worth it? Especially when you drive off the lot and it drops $15,000 the second you get down the street.
Yeah, so let's turn that around then. So looking at $50,000-$60,000 instead of having a drop when you drive off the lot, shouldn't we be investing that $50,000-$60,000 somewhere and have it compounding over time? Better solution, right?
Yeah, don't look at the car as your personality. Look at it as transportation. That's what I've always done.
Right.
Get something practical, and that so many people are leasing now because they can get a big fancy car, and they don't think it costs them as much because they're looking at it in terms of monthly payment.
Right.
And it's more than that.
Right. Right. All right. So, and quite honestly, that's a whole nother subject too, leasing versus buying, right? All right. So let's go on to credit card debt. That's the revolving side of this story. So credit cards, Americans are doing what they do best, and that's spend money that they really don't have. Okay. If there's one thing we can do great, is spend money we don't got. Credit card usage surged billions of dollars to bring this total debt. Everybody hold on to your shorts, because we're going to talk $1 trillion plus. That is so huge, Brad. How are we going to even combat that? How are we going to safeguard from that kind of debt on the consumer side?
Well, that's a good question, because interest rates are rising, and credit card companies are going to follow, although they charge exorbitant amounts for it already.
Right.
They've got a good mentor to learn from, and that's federal government.
Yeah.
So they're real good at spending money they don't have. So Americans are just following suit.
Sure.
But it's people are just going to have to watch that, because that was a big problem back in 2008.
Yeah.
And that caused a lot of issues. People were looking at using their houses as an ATM machine and racking up credit card advances, and
sure.
I mean, every time you turned around, you were getting an offer from a credit card company. Hey, get zero money for a year, and although that seems to have slowed down quite a bit,
right,
but people are still racking them up.
Let's talk about 2008, in particular September, around that time frame, where it was a rare moment, Brad, where the world shifted beneath our feet. Okay, and the markets froze. The financial industry looked as if it was going to be nationalized. So banks, are they going to be worried about this debt that we're seeing now at $1 trillion? Are they going to be concerned about that? Can we reface something that we saw back in 2008 again?
Well, with regulations, they've gotten a lot tighter.
Okay.
And so I think the more they deregulate, the more we go back to community-type banks, the better off we are, because you're not dealing with massive, huge banks.
Right.
And plus, community banks do a better job of servicing their clients, because they're local.
They're local.
And I deal with a community bank, and I love it. I don't want to deal with a big bank.
Right. Well, and they seem to be a little bit more conservative on their lending practices, too, because I know I was with U.S. Bank, and they kind of made it through 2008 area where a lot of other banks were panicking because they did loans that they probably should have never done, or did loans because of deregulation that were forced on them. Whereas some banks, where they're a little bit more conservative, they kind of fared through it better. And I think some of those community banks are more conservative, would you say, than some of those national banks?
Yeah, they are, and they have a feel for their local community. They know when things are rising, when things are falling, and they know people's reputations. And oftentimes, a big bank may not give a loan to a businessman that a community bank will,
right?
And because they know he's good for it.
That's right.
And so, there's a lot there. The banks are in a little different position because they're not so highly leveraged the way they were in 2008.
Right. Okay. Well, this is where it comes.
You don't have all those credit default swaps to fall back on.
That's right. That's exactly right. Plus, those local banks, they know the face. They could care less about the number, like some of these other banks. They know you by a number. These local banks, they know you by a face. So, what's the best way to resist debt and save more these days?
Well, just live within your means. It's kind of a simple formula.
It really is.
Make sure that your income exceeds your outgo, and but don't just let it sit there. Do something with it.
Yeah. What kind of tools are available to do something with?
Well, there's all kinds. The market's kind of in a peak, so be careful. How much you dive into the market at this point, because it's showing signs of the last legs of a good bull market. But CD rates are coming up, and looking at income generating securities. If you're in an older position, obviously if you're younger and you got time, just use the indexes and let it ride.
We're out of time. Brad, where can we find you?
AskBradWilliams.com.
AskBradWilliams.com. Head on over today. We'll be right back. Stay tuned.
Thanks, Kurt.
You bet.